Welcome back all to another lecture, and we have a really interesting topic here today, securitization. As you know, this is kind of a base of kind of modern banking or after the subprime crisis. If you have worked in any asset management company or any banks that deals in assets or any of these organizations related to income generating securities, then you have heard this word. So we will go ahead and see what this means, some of the key terms associated with the securitization, and what is the securitization process. So let's begin. So securitization, what is it? So this is generally the definition. So it is a process in which certain types of assets are pooled so that they can be repackaged into a interest-bearing securities. Now, what does this mean? That securitization is nothing but just mixing up assets or bringing in assets together and repackaging them into a new kind of security or interest bearing security. So that is the general meaning of securitization, bringing in certain types of asset together, repackaging them or putting them in a new package and selling it to the clients or the customers. So issuer create marketable financial instrument by merging various financial assets into tranches. So here the issuer will go ahead and create these pools or asset pools and divide them into something known as tranches and sell those to the investors. Now, what are these terms? We will go ahead and see. Originator. Originator, as you can see, the term indicates origin. So this is the point of origin or an entity in our terms, a company or entity with loans or other income generating assets. These originators have these assets out of which these pooled assets or the securitization process is to be carried out. So originator is the one who has these assets. Next term is the issuer. So issuer, the entity that creates and sells the security backed by a pool of underlying asset. So there is another party involved, that is the issuer. They are the ones that will go ahead and kind of bring in these assets, make the packaging, decide the terms and conditions of the packaging, and then kind of go ahead and sell these. So they do the structuring basically, this issuer. So as you can see here, in the definition itself, if you come to the third line, the issuer is typically responsible for structuring the securitization process, which includes assembling the assets, creating the SPV if applicable, and issuing the securities to the investor. So what is a SPV? We'll come back. So remember, originator, the party or the entity that has the assets. There is a issuer who will, on behalf of them, go ahead and do the structuring of the originator assets, SPV. So as you see, as you have seen, the kind of issuer will go ahead and create an SPV. So what SPV is? So the full form of SPV is special purpose vehicle. So it is not a kind of automobile, right? It's not nothing like that, but it is a term which facilitates the movement. That's why a special purpose vehicle. So to facilitate securitization, an SPV is often created. So this is kind of a entity, a legal entity that is created so that uh, in the securitization process, many of the part or the kind of transfer of the assets happen to this SPV. So remember, SPV is a legal entity. So as per the definition, this legal entity purchases the underlying asset and issues securities backed by those assets. The SPV helps isolate the assets from the originator's balance sheet, thereby minimizing risk. So we'll go ahead and see the entire process. Then there is another term, the tranches that we saw in the first line. So tranches are nothing but pieces, kind of, or slices. So tranches are slices or segments of a securitized financial products such as a MBS or a CDO. So in simple language, if you bring home a pizza divided into many parts, each part represents a tranche. So in a layman language or a simple meaning, each part of a pizza represents a tranche. So remember, tranche is nothing but slice of that complete security, or whatever asset the security is based on, slices of that new structured product. So that's it. So basically there are three kind of tranches. We'll go ahead and see based on different level of risk and return. So tranches, the three tranches are the senior tranche. These have the lowest risk and typically offer lower yields. So they are the first to receive payments from underlying cash flow, making them more secure in the event of default. So coming back to our pizza example, let's say your parents or friends have bought the pizza and they have divided it. Say there are three categories they have divided into the pizza: the senior tranche, mezzanine tranche, or junior tranche. So what is the senior tranche basically? So senior tranche is something which is safe and secure, but the interest or the yield that you get from it is low. Say for example, in that pizza example, the senior most tranche are those pieces of the pizza that are maybe smaller in size, but there is a guarantee that you will get the piece. You will get to eat it. It's a guarantee. So the yield is lower because your piece may be small or your slice may be small, but there is a guarantee that you will get to eat it. Mezzanine tranche. These carry moderate risk and offer intermediate yields. They receive payments after the senior tranche. So again, coming back to the pizza example, these are those slices which are bigger than the senior tranche or the smaller slices, and also has a kind of guarantee that you will get to eat it. But the condition is that once the senior tranches or the smaller pieces, the people who will be getting the smaller pieces, once they have completed eating their pieces or the slices, then only you will get to eat your slices. So in this thing, what is the thing is that you are getting a bigger chunk of the pizza, but you have to wait a little bit. Then there is the junior or equity tranche. So these are the riskiest, receiving payments only after the senior and mezzanine tranche. They offer the highest potential returns but are also the first to absorb losses from the defaults. So again, explaining in the pizza terms. So after the mezzanine tranche, let's say there are slices which have more cheese or say more toppings. But the catch is that once all the slices of the pizza are eaten by the senior and mezzanine tranches, then only whatever is left will be available for consumption by this the third category that chooses the junior or equity tranches. Now the advantage is, say for example, senior and mezzanine tranches have had their meal and there is a huge chunk of pizza left with extra cheese and extra toppings, then the best thing comes to you. However, the risk is if senior and mezzanine tranche have finished off the pizza, then there might not be anything left for your consumption. So it has a very high risk that you might not get whatever you expected, but if you get, the returns are very high. So this is what basically tranches are in securitization. I hope I was able to explain you in a simple term. Now the process of securitization. So the first process in the securitization is asset identification and pooling. So selection of asset. The originator, usually a financial institution, identifies a pool of assets to be securitized, such as mortgage, loans, or receivables. Now, for example, there is a bank. So, a bank might have, say, 1,000 portfolio of mortgages. So, this is an asset for the bank, and also these mortgages generate income uh, in the way of interest and principal. So the first part of the securitization process is in the originator. We saw that pool of assets where these are restructured into income generating securities. So selection of assets. So we have selected, say, mortgages. Pooling. These assets are combined into a single pool to diversify risk and create a more attractive investment product. So what does this mean basically? Say there are thousands portfolios of mortgage loan, some which are very risky, the owners might not pay, some which are, say, very safe, that the people who have taken the mortgage will pay. Now if they pool only one category, say those risky assets into one category, and try to present it to an investor, the investor might not buy because it is very risky that they might not pay out the mortgages and they might lose. So what happens in pooling is different kind of portfolios or different kind of assets are combined into a single pool. These assets might vary in the benefits offered. These assets might have different economic exposure. So, based upon the risk, these are brought into one single pool to diversify risk and create a more attractive investment product. Next is the creation of a SPV. So, this is seen that SPV is created many times, but it's not necessary that SPV is every time created. But in general, SPV is created. So SPV formation, the originator establishes a SPV. So let's say there is this bank X. So they went ahead and created another legal entity, say Y. Y is a SPV that was created for the purpose of pooling assets or buying assets, let's say the mortgages from bank X. Now what happens is these SPV will hold the pool assets. Once this SPV holds this asset, the originator's balance sheet is free. They can go ahead and utilize their balance sheet to procure another class of loans or mortgages, or they can raise funds. That means the risk of default has been transferred to the SPV completely, making the originator free of this risk. So SPV is basically created to kind of absorb the risk from the issuer or the originator, sorry. So you can pause the slide and then definitely go ahead. Now the transfer of assets. The originator sells or transferred the pooled assets to the SPV. So once the SPV is created, the pool of assets or the pool of, say, for example, the mortgage loans has been transferred or sold to the SPV. The next phase is structuring. The first thing in structuring is creating of tranches. The SPV creates different tranches of securities, each with varying levels of risk and return. So we already went ahead and saw that there are three kinds of tranche basically in general: the senior, the mezzanine, or the junior or equity. So the SPV will create these tranches from that pooled security based on the risk and return that each tranche generates. This allows investors to choose based on their risk appetite. So basically, say the pooled assets has four mortgage loans. One is very risky but has a very high interest rate. The second is, say, less risky with less interest rate. The third is, say, again a high one with low interest rate, and the fourth, say, it's medium with decent interest rates. Now what the SPV will go ahead and do is they will divide these four mortgage loans into tranches. Say in tranche, senior tranche will have all those loans or mortgage loans which are lower in risk and has lower returns. The mezzanine will have medium risk mortgages and medium returns, and the equity tranche that are created will have the highest risk of default or highest risk of not being repaid or not getting any outputs, but with very high interest or very high kind of returns. So this is done by the SPV in the tranching phase. Then there is the credit enhancement phase. So this is also a optional step. It is done majorly, but it's not necessary that everywhere it is done. So the issuer may add credit enhancement like insurance or over collateralization to make the securities more attractive and reduce the risk of default. Say for example, as if the pool was made, now in the pool it was observed that there are very high risky mortgages. Number of risky mortgages is very high. So it might happen that investors might not purchase that security. So in order to make it more credit eligible, this step is done. So they will go ahead and say that we are insuring this new product. So people might think that investors might think that okay, at least there is an insurance. If something happens, insurance might cover it. So this kind of credit enhancement are done. Then there is the phase of issuance of securities. Now we have pooled the asset, we have made the tranches, we have did the credit enhancement, everything we have done. Now the next phase comes of issuance of securities. So documentation, legal and financial documentations are prepared, including a prospectus or offering memorandum that outlines the terms of securities and underlying assets. So an offering memorandum or a prospectus is created. This has all the information regarding the tranche, the security, or whatever the product is created. What are the terms and conditions? What are the risk and return you are going to get? So all these kind of things are present in there. And also along with this, many legal documents are created in which terms and conditions are outlined. Then once this is done, finally, the sale of securities. So the SPV or the issuer issues the securities to investors, often through a public or a private offering. So there are basically two types of offering. One is the public offering, one is the private offering. Public offering is when it's open to the public, anyone can go ahead and purchase, and there is also a private offering where few people or it's privately offered to few of the big institutional investors or this kind of parties. Now we have issued the securities, investors have bought the securities. The next phase comes is the collection of cash flows. The first may be defined as the payment streams. So when these underlying assets, let's say for example, when we have created the product based on mortgage loans, now these mortgage loans are being repaid or the interests are being repaid. That means this asset has, the underlying asset has started to generate cash flows, right? So now these cash flows are collected by the SPV or the issuer or the party that is like associated with this type of transactions. Many of the times the issuer or the SPV goes ahead and they will appoint a trustee or a kind of a third party to overlook their functions. So in that case, the third party will go ahead and do all these things that the issuer or the SPV is doing. So once the payment is collected by the SPV, then the next phase is the distribution phase. So what is the distribution phase? So this money is collected. Now this is distributed to the tranche holder. Remember, the senior, mezzanine, and the equity or junior tranche. This cash flow is then distributed by ensuring that the senior tranche gets the payment first, then the mezzanine tranche, and then the junior equity tranche. So this prioritizing payment based on the tranches or the payment that flows out, this process is also known as the waterfall payment. So now the payment has been done. Now ongoing management and reporting. So monitoring. In this, the performance of the underlying asset is monitored by this SPV or the issuer or the trust to manage risk and ensure compliance is met with the terms of the securities. So we have had many of the legal documents, the offering circulars, offering memorandums, which outline the uh, terms of the deal. Now this is also monitored so that nothing goes haywire. Reporting, the SPV or the issuer or the trust also goes ahead and does regulatory reporting. Along with that, they will also report about any updates to investors about the underlying assets and the payment status of the securities. For example, if there was a default and payments were not available, or say little payment came through, so there will be a communication to this kind to the investors from the trust or the appointed trust or the SPVs that senior tranche will be paid this time, the junior and the mezzanine won't be getting any payments as outlined in the legal documents. So these kind of things are communicated by the SPV or the uh, appointed party. Maturity and payoff. So final payments. As the underlying assets reach maturity or are paid off, final distributions are made to the investors. So we have issued securities. These securities will have a kind of date on which these matures. It's like similar to a bond. So it will have a maturity date in which the amount that you have invested will be repaid along with the interest or the benefits and the returns that were outlined during your transactions. So this is the final payment that is done. Now, dissolution of the SPV. So once the purpose for which the SPV was created is complete, all the payments have been done at the maturity, the payoff is done, everything is cleared, the SPV is dissolved. So this is the complete structure of the securitization process. This is a diagram to explain what we talked about. So let's see it quickly. So there are three parties, the originator, the SPV, and the investors. Then there are the borrowers. So what happens before creation of any SPV or securitization, the originator, the originator here gets the cash flow. Before securitization, the originator is getting the cash flows. After securitization, the originator transfers all the assets to the SPV, and SPV purchases these securities from the originator and kind of frees up the balance sheet of the originator. Now, whatever the risk is with the SPV. The borrower payments are collected by the SPV. They are paid to the investors as interest and principals, and investors buys securities from the SPV. And this is how the whole process of securitization happens. I hope you understood what securitization is and why securitization is done and what is the overall flow of securitization. Now the advantages. The first advantage is liquidity. So securitization process converts illiquid assets into tradable securities, providing liquidity to the originators, as explained. So mortgage payment or lease payment. So these kind of payments are illiquid, means there is a certain time frame in which these are taken or needs to be settled. So these are kind of illiquid assets. Now, when it is made into a security, that new security can be sold off, and the entire amount can be brought in by the originator. So, covering the concept of liquidity. Then there is the risk distribution. Spreads risk, like we saw the SPV bought the kind of the asset pool from the originator, and the originator was free of the product, and hence the risk associated with it. Also, risk distribution is done through creating tranches. Then capital relief frees up capital for the originating institution, allowing for further lending on investment. It's kind of the similar. You have more capital in your hand by selling the securities to the SPV or asset pool the SPV. You are getting back your capital. Customization. Investors can select from various tranches based on their risk appetite. Since securitization process involves creating of tranches, so investors have more and more options based on their risk appetite, whether they would like to go with the senior, mezzanine, or junior tranches, and hence customization can be done. So these are the advantages of kind of the securitization process. So that's it from my end, folks. And thank you all once again. We have broken the 900 subscriber mark. So this is extremely awesome support from you all. Just watch the videos till the end and keep subscribing, keep spreading the love, share it if you found it helpful, and please do comment down. So thank you so much and have a great day.